In 1994, a group of the sharpest financial minds on the planet put together a fund that, by the math, couldn't lose. Among them, two future Nobel laureates in economics, a former vice chairman of the Federal Reserve, a legendary Wall Street trader who hadn't been wrong in years. Together, they built a mathematical model that seemed to see straight through the market. 4 years later, that model lost $4.5 billion in a matter of weeks, and nearly took down the entire U.S. financial system. This is the story of long-term capital management, one of the most unsettling episodes in the history of markets. Not because it was built by fraudsters, but because it was built by some of the smartest people anyone could find, and that's exactly what destroyed it. Most retellings of this story boil it down to one word: greed. But the real reason is far scarier. It's not about greed. It's about what happens to the human mind when it starts to believe it has found a formula that eliminates uncertainty. Its founder was John Meriwether, a legend of Salomon Brothers' arbitrage desk. In the 80s, his team brought the bank as much as 80 to 100% of its total profit. At one point, his small group of traders was responsible for the majority of the firm's earnings year after year. In 1994, he assembled something the world had never seen: former Salomon traders, a former vice chairman of the Fed, and most importantly, Myron Scholes and Robert Merton, economists whose options pricing model was already woven into the foundations of modern finance. In 1997, they would win the Nobel Prize for it. To put that in perspective, their formula wasn't some obscure academic curiosity sitting in a journal somewhere. By the mid-1990s, traders on nearly every desk on Wall Street were already using some version of it every single day to price options. Putting its own inventors inside a hedge fund felt, to investors, less like hiring smart people and more like getting direct access to the source code of modern markets. Getting into the fund cost a minimum of $10 million. Your money was locked up for 3 years. Investors weren't even told what they were invested in, and people still lined up to get in. The strategy sounded elegant: find tiny price discrepancies between similar bonds around the world and profit as those discrepancies converged over time. They called it convergence arbitrage. Here's the simplest way to picture it. Take two bonds that are practically twins, same risk, same maturity, almost identical cash flows, but one is trading a few cents cheaper than the other just because of some temporary quirk in supply and demand. Buy the cheap one. Sell the expensive one short. Wait. Sooner or later, the market corrects itself, the prices converge, and you pocket the difference. It works almost every time. The problem is, the difference you're pocketing is tiny, sometimes a fraction of a single percent. To turn that fraction into something an investor would actually notice, there was one ingredient you needed: leverage. Enormous leverage. The early years were spectacular. 20% returns in 1994, 43% in 1995, 41% in 1996. By 1998, for every dollar of its own capital, LTCM was carrying more than $25 in borrowed positions. That's on the balance sheet. Off the balance sheet, more than $1 trillion in derivatives. The Scholes-Merton model was built on historical data, and it assumed markets would keep behaving the way they had for the past several decades, that correlations between assets were stable, that extreme events were a statistical rarity, something that almost never happens. This wasn't just a trading strategy, it was a belief that uncertainty itself could be tamed with mathematics. And this is where the real story begins. Not a story about money, but about what happens to people when a model replaces their instinct for fear. In the summer of 1998, the thing the model called almost impossible happened. The 1997 Asian financial crisis spiraled into Russia, defaulting on its debt in August of 1998. Investors around the world rushed, all at once, to dump anything risky and pile into the safest asset there was: U.S. Treasury bonds. This is the part the model never saw coming. When everyone panics at the same time, they don't act like rational, independent traders following separate strategies. They act like a single herd, all running for the same exit at once. Every assumption baked into the model treated each trader as an independent decision-maker. But fear doesn't behave like that. Fear is contagious. The moment one major fund starts dumping a position, every other fund watching the same screens reads that as a signal to dump it too. Not because the fundamentals changed, but because everyone else is suddenly running. The spreads LTCM was betting would narrow didn't just fail to narrow, they blew out to levels that had never been seen in the historical record. The model turned out to be right about one thing. This had never happened in the historical data, simply because it didn't have enough history to have ever seen it coming. What came next was a trap no formula had predicted. To meet its margin calls, LTCM had to start selling assets. But its positions were so enormous and so concentrated that selling them meant crashing the very prices it was trying to sell at. This is called a liquidity trap, a market where there's no buyer for your size at the exact moment you need to sell the most. Other firms on Wall Street knew exactly what LTCM was holding because the trades were so distinctive. So instead of helping, some traders began selling those same positions ahead of LTCM, pushing prices down even faster and making the fund's losses worse with every single day. The fund was losing capital faster than anyone could have imagined. In September of 1998, the Federal Reserve Bank of New York gathered the heads of LTCM's 14 largest creditor banks in one room and effectively forced them to inject $3.65 billion to buy out the fund and unwind its positions piece by piece instead of one single collapse. This wasn't a bailout with taxpayer money. It was the system saving itself from itself, because LTCM's collapse threatened to freeze credit markets worldwide. The Nobel laureates lost almost everything. The fund was fully liquidated by 2000. Here's what most retellings of this story leave out. It wasn't that LTCM had a bad model. It's that any model built on historical data has one fundamental blind spot. It can't see an event that has never shown up in the sample yet. Investor Seth Klarman put it bluntly. It was reckless to combine extreme leverage with a model that didn't account for rare, outlier events. And Mitch Kapor, a software designer who knew LTCM's partners personally, called their approach not a science, but a faith. The most unsettling part here isn't that these people were wrong. The most unsettling part is that they were some of the most qualified people in the history of finance, and it was precisely that expertise that convinced them uncertainty could be calculated. The more confident an expert is in their model, the less room they leave for the thought, what if this time is different? And here's the detail almost nobody mentions when they tell this story. John Meriwether didn't disappear after 1998. In 1999, just months after the bailout, he opened a new fund called JWM Partners, with several of the same partners, and a very similar strategy. He told investors this time it would be different. Lower leverage, better risk controls. Lessons learned. For close to a decade, it actually worked. Then came 2008. As global markets seized up again, the very same kind of trades that destroyed LTCM started bleeding losses at JWM. The fund lost roughly 44% of its value between late 2007 and early 2009. In July of 2009, John Meriwether closed the fund for good. The man who had personally lived through the most expensive lesson in financial history still walked straight back into the same kind of trap a decade later. That's not a story about one bad year. That's a story about how hard it is for any of us, even an expert who has already paid the price once, to truly believe that the rules can change again. It suggests something almost uncomfortable. Surviving a disaster doesn't automatically teach you to fear the next one. Sometimes it just teaches you a slightly more polished version of the same confidence that got you into trouble the first time. This isn't a story only about hedge funds. It's a story about anyone who has ever been sure that this time it's different. Ebit Orihan. Gestahand, when they bought into a falling stock, doubled down on a cheap buy with everything they had, or ignored the risk because the model, a spreadsheet, a strategy, someone's hot take online, told them everything was under control. LTCM is a reminder. The more complex and convincing a system looks, the easier it is for that system to hide the one moment when you simply need to admit, we don't know what happens next. The irony is that admitting that out loud has never cost anyone a fortune. Pretending you don't need to is what tends to do that. Has there ever been a moment when you were sure you had the market figured out and the market did the opposite? Tell me in the comments. If this story got you, subscribe. More breakdowns are coming. Crashes, frauds, and the behavioral traps that caught the smartest people on the planet.